All right, let's talk about three of the most popular and honestly most confusing investment choices out there for beginners. Today, we're going to create the definitive explainer to demystify SPY, QQQ, and the total market.
Okay, so let's dive right in. You're trying to start your investment journey, and it feels like these three tickers, they just pop up constantly, everywhere you look.
And you know, everyone has an opinion, right? But the most crucial point to get is that this isn't a competition. It's not good versus bad. By the end of this, you're going to know exactly what each of these tools is built for.
So here's how we're going to do it. We've structured this to take you from total confusion to complete clarity. We'll start with the dilemma, get one rule down, meet the big three, figure out your risk personality, expose the biggest mistake, and then give you a simple blueprint to get started.
First things first, let's just acknowledge the core problem here. Feeling overwhelmed? It's completely normal. But look, the goal isn't to find some perfect ETF. The real goal is to find one you can hold on to without second-guessing your entire plan when things get rocky. So let's move to a single, really powerful rule that's going to give you a default path forward. This will build your confidence and cut right through all that noise.
This right here, this is the key takeaway for any beginner. If you don't know what to pick the broadest one. Why? Because you need to prioritize a strategy you can actually stick with through fear rather than finding some perfect but super volatile fund that you might just abandon at the worst possible time.
Okay, now let's define each of these in plain English so you know exactly what's inside. What are you actually buying?
So, a total market fund, it's exactly what it sounds like. It gives you the maximum diversification possible. You're spreading your investment across thousands of companies, the big ones, the small ones, all of them. Now, SPY is a bit more focused. This is like the core of big company America. You're getting the 500 most well-known, established corporations. These are the household names. Then you have QQQ. This one is the most concentrated of the three. It's focused on innovators, mostly from the tech sector. That means it's got higher growth potential, but you guessed it, also higher risk. Now, what's really interesting here is how this table clearly shows the trade-off. As you go from total market down to QQQ, you are cranking up the concentration. You're making a bigger and bigger bet on fewer companies.
You know, understanding the data is only half the battle. The other half is understanding yourself. It's about how owning these things will actually feel during those crazy market swings. So think about your own personality. Seriously, do you prefer a smooth, steady ride, or are you more of a thrill seeker, someone who wants a faster ride with bigger bumps? So QQQ, that's your high-performance sports car. It's super exciting when the market is climbing, but man, those drops can feel way more intense.
SPY is kind of like the reliable family sedan. You know, it's solid, it's powerful, and it's a dependable core for pretty much any portfolio.
And owning the total market, well, that's like owning the whole car dealership. You get a mix of everything, which naturally smooths out the overall performance. All right, let's move to probably the most important part of this whole thing. Let's look at the one trap that costs new investors the most money.
So here it is. This is the crucial point. You have to stop looking backward at past returns and start looking inward. Stop asking which one went up the most and start asking yourself, can I really truly hold this when it drops 30, 40, even 50%?
Okay, let's turn all this theory into a simple, actionable plan that you can set up and just stick with for years and years to come. And just notice the simplicity here, okay? The goal is not complexity. The goal is a clean plan that you can follow without getting confused. So here's what one of those blended models actually looks like. You get a strong, stable core with that big slice of SPY, and then you add a smaller allocation for that higher growth. But the real secret, it isn't which model you pick. It's executing this two-step process relentlessly, because most wealth is built by consistency, not by being clever. You just keep going. So as we wrap this up, I want to leave you with this one thought. Choose your plan first, then choose the ticker that fits it. Because that's the real key to long-term success. And of course, please remember this is all for educational purposes. It's not financial advice, so make sure you do your homework.